Stablecoins are the backbone of digital payments, and soon companies like Amazon, Google, and Apple might be issuing their own. Meanwhile, firms like Ondo Finance are tokenizing US Treasuries. So what does this mean for the future of money? In this video, we're going to run down the definition of stablecoins, how they work, what's backing them, their history, and market trends moving forward. All right, so what is a stablecoin? A stablecoin is a cryptocurrency designed to maintain a stable value. Typically, these are pegged to fiat currencies like the US dollar. Many of you may know Tether. What they do is they reduce volatility and enable fast transactions to move in and out of trades in a seamless way instead of having to go back to fiat currency. It's a representation of fiat currency as a crypto, basically. And they're pegged. So how do they work? Well, they should be backed one-to-one, according to the US government in the regulation that they're rolling out, by cash or cash equivalents. So USDC and ROUSD have basically blazed the trail on this. Tether, not so much, and we'll get into that. But they cannot be crypto-backed in the regulation that's been proposed here in the US. In the past, there have been a couple other models, and this is kind of the history of stablecoins, where maybe they've been over-collateralized by other things. So Bitcoin has been used by Tether to back their cryptocurrency or their stablecoin more prominently in the past, and then reduced that on their balance sheet in the most recent years. You've got DAI, which is an over-collateralized stablecoin. And then you had algorithmic stablecoins like UST. Obviously, that was a blunder and didn't end up going very well when it all fell apart. They were paying 20% interest. It obviously wasn't sustainable. But there are many stablecoins that do pay some type of interest, and we'll get into that as well. So they're used in transactions and mostly just payments between counterparties. They can move 365, 24/7. They don't need an intermediary like a bank to be able to settle the payment between people. Most of the time, they go from exchange to exchange, right? So let's say I wanted to close a transaction for a home on a weekend. I could do that with a stablecoin. Whereas if I have to wait for my bank to send that payment or deal with the escrow or their clearinghouse, or there's lots of things where there's intermediaries that currently cause a lot of frictions and take a lot of payment or fees for providing these payment services. Whereas with stablecoins, as long as you trust the counterparty that's issued the stablecoin, that it is backed one-to-one, you can move that money anytime you would like. And that's one of the main benefits of all of these financial products moving on chain, is the ease of transfer between them on a 365, 24/7 basis. Let's get into what actually backs the stable coins and where regulation actually sits on this. So there isn't actually any regulation here in the US, but MiCA, or MiCA, however you want to say it, over there in the EU, does have full regulation for stablecoins. Tether does not meet the designation for that, and so they've removed themselves from that jurisdiction. We just saw them offshore from the US and go down to El Salvador is now where they're domiciled. And this is because they're using portions of their balance sheet for commercial paper, and a portion of that is Bitcoin. Somewhere between 3 to 5% of their balance sheet is Bitcoin. A portion of that is locked up in a lawsuit right now with Celsius from the whole debacle when everything fell apart in 2021. That kind of brings us to the tokenization of treasuries and bonds. And we've seen a huge interest in this over the past 2 years here. We were at Consensus last year. There was a RWA summit event where they had Ondo and Securitize and many others from the traditional space. They're talking about tokenized treasuries, which seems pretty boring, but it's the first step in that direction. These pay the terms of the treasury. They're a digital representation of the ownership of the underlying treasuries on chain. Ondo is doing this with BlackRock. BlackRock is, very much involved with Ondo and Securitize. Securitize is more on the hedge fund and tokenization of funds side of things, which is a bit separate from stable coins, but they have their opinions. Carlos over there. So why would institutions prefer stable coins or tokenized treasuries versus the underlying asset? Well, again, derivatives become much easier to move, especially if they're on chain and they're liquid. And you can set up smart contracts between you and a counterparty that you may not trust. You don't need an intermediary broker or a third party to be able to facilitate a transaction if you both trust the code to be able to transact these assets. And again, there's been other players like DAI that have backed things with ETH and Bitcoin and other real world assets. Every jurisdiction is going to have their own regulation around this. And the US obviously is going to want to continue to make it where the US dollar is the main backing mechanism for US dollar denominated stablecoins. They're not going to want you to be able to use gold or other things. And again, we just set aside your libertarian thoughts on those things. I know I'm of the mind that I would like a gold-backed stablecoin. There are some. Paxos does that, but it's not really a stablecoin because again, the value of gold appreciates based on inflation and other factors. There's paper gold, which is a derivative and allows it to trade much easier than moving the underlying asset. And that's really what this is all about. If you're able to have an immutable, transparent, auditable, on-chain derivative of whatever the underlying asset is, it makes it much easier to transact. It makes it much more liquid. Even though treasuries already are very liquid, you can now move them 24/7, 365, instead of having to deal with, again, intermediaries or brokers. So what does this look like over the long term? Like, who's going to be issuing these things? Who are some of the players that are in the space and are going to come into the space? So a little brief history. Tether was the first ever stablecoin. Many of you will know USDT. It was launched in 2014. And then we had USDC that came along in 2018. They did some interesting things with loans on Bitcoin in the beginning, but now they completely moved to US Treasuries and money markets. A very boring business, but very profitable. And that's one of the other reasons I want to mention here that some of these big players might step into the space. Tether is the most profitable company on the planet, even more so than BlackRock. And they only have 100 employees. How is that? Well, the margins that they operate on for the lending and the other stuff that they're doing, pretty significant. And so that's very appealing to banks and institutions and enterprises here in the US that might have large swaths of the economy already using their software. Microsoft, Google, Amazon, social media platforms. So we've seen, again, multiple iterations of this, and I think the big players are coming once we see the regulation. But in 2020 and 2021, we had a DeFi boom. There was, again, UST, DAI, and some other stable coins that are no longer around. They got a lot of traction and then went under because they were Ponzi schemes. Terra Luna's collapse is probably the poster child for what not to do when it comes to stablecoin and the risks associated with them. And again, why you would want an auditable, transparent, immutable backing that is a one-to-one value representation of whatever the underlying asset is, and not something that's predicated on the value of another digital asset like Luna that people arbitraged the whole way down and it basically went to zero. It's still around. Luna C and some of the other stuff people speculate on. It's kind of a meme coin at this point. But here in 2025, we do have bipartisan agreement that we do need regulation around digital assets and stablecoins. Trump has said that we will have stablecoin regulation by August of 2025 at the recent crypto summit. So that's my anticipation. I think we're going to get this. There's a couple bills that are currently on the floor of the House and the Senate for them to vote on. They're written a little bit differently, but this will give oversight of the OCC to stablecoins, as who I think the regulator will be. And it'll keep it away from the SEC and the CFTC. And we'll see how the Federal Reserve or the Treasury are involved with this. We have a lot of people thinking that our currency here in the US might change, and I'm a proponent of that. We'll see if that actually transpires or not. But we got to play with the cards we currently have in our hand until that happens. So some of the expected requirements, again, Ripple's kind of been the poster child for this with ROUSD. They have a full backing one-to-one with cash deposits or cash equivalents like US Treasuries that are backing their stable coin, which is ROUSD or Real USD. They're providing audits and they have a banking license. They have a trust bank there with standard custody to be able to provide custody, institutional grade custody for the underlying assets and the stable coin services that they're providing other enterprises and people to be able to settle payments. And again, very profitable business for them to be getting into. Makes a lot of sense and is complementary to XRP and their long-term vision. So with Ondo Finance and BlackRock leaning in toward tokenization of US Treasuries here and those moving on chain, I think you're going to see a lot of other real world assets tokenized, and stable coins are going to be required. They're basically the prerequisite for the transfer of value between those financial products that are being tokenized and something that is risk off. right? So talked to Graham just recently over there at Archax. They have a money market account that's been tokenized. I think you'll see those as well. Some way to be able to move very quickly from stocks. You could day trade all day long, real time, with actual settlement, real time settlement between a stock that you thought was going to appreciate in the morning before the open. Many people trade pre-market and post-market on the S&P and many other indexes and stocks as well. And so if you wanted to get in and out quickly and still have your assets earning some capital, you could trade between a tokenized stock or a tokenized index that was on chain back to your money market account. And you could do that all day long. You'll have algorithms and bots that do that produce pretty significant yields, is my anticipation in the near future, as all of this does move on chain. So again, what does this look like for long term? I mean, who are the players that are going to step into the space? Obviously, Tether is the big dog at this point for stablecoins, and many people think that that will persist into the future. I'm not so sure about that. We've talked about this on the channel before. I think that there are, especially after stablecoin regulations get put in place here in the US by Congress, ways that Tether could end up being sanctioned by the US government or not allowed to be used here. We've already seen a few exchanges in the US delist them, Crypto.com being the poster child for that and kind of the leader to delist USDT. And I think many others will follow suit. Coinbase has discussed it. But if they don't, and there is a situation where they're dependent on that liquidity from USDT to be able to transact and settle payments and move in and out, which most exchanges would be if they're not liquid enough, like Crypto.com. They have CRO, and Binance has BNB token, but many of the other exchanges don't necessarily have a token that could provide liquidity or is a DEX for them to be able to lean on if there were a liquidity crisis from Tether. So that's what I think may transpire here and happen when stablecoin regulation potentially is rushed through in the near future, if there were a catalyst that would cause that. But you'd also want that if you were a large enterprise here in the US that wanted to move into the market in a meaningful way. You would want the 100-pound gorilla in the room to be handicapped. And I think that that is going to be the case. I think Apple, they have an Apple Wallet. It's on most people's phones if you have an iPhone. Google Wallet, you have it if it's on Android. Sometimes, you may download that even on your iPhone. Android might have a stablecoin. Amazon, there are lots of players in the space that already have banking functions and payment licenses. We've seen X acquire a ton of payment licenses across the majority of the states here in the US in the anticipation to launch their payment mechanism on their platform. We've seen Telcoin on Telegram that's gained a lot of traction, market cap very quickly. It was in the top 20 until some regulators got involved. So I think that there's going to be a lot of players that do want to move into this space in a meaningful way, but they are waiting on regulation. And I think it'll be strategic when they roll that through. So last thing I want to touch on here before we let you go and wrap things up is CBDCs versus private stablecoins. Trump has signed an executive order here in the US that states there will be no CBDC or central bank digital currency issued for US from the Treasury or the Federal Reserve. I think it's from the Federal Reserve. Treasury, I'm not so sure. We will see what actually ends up transpiring, but that aligns with capitalism and how the U.S. works. In other jurisdictions like China and maybe even Brazil or Japan, North Korea, there are cultures that rely heavily on the government. The government has a lot more control, and the people are fine with that there. And so the CBDCs that they issue there will have smart contracts that stipulate, based on your credit score and other things, what you can and cannot spend them on. I think that there will be choices. Banks and institutions will issue stable coins and provide incentives to hold those alongside the other enterprises I mentioned before. In the regulation as it sits today for Congress, it states that there will be no mechanism to pay a return to people for holding stable coins. That doesn't mean that they won't be able to issue rewards like credit cards or do some other things with them. There may be ways to skirt around that. As an example, this is a good one. Starbucks is not a bank, but they have so much money from the gift cards that people have purchased that they allocate that and make investments with it and basically run similar to an endowment type structure with the funds that they have there for their capital. And a large portion of that's in risk-free returns, money markets, treasuries, things that aren't going to be a problem if people want to redeem those dollars, obviously. But I think that you're going to see that function happen across a lot of other players in the space, and they'll have a regulated way to do it. And even Starbucks might step into the space with a stablecoin if they were to, utilize the treasuries that they have currently to be able to provide that to their clients. If you wanted to hold their stablecoin and be able to spend it there, maybe there's some type of discount that you receive if you're using their stablecoin to pay for things. If there's not a way to pay you some type of yield of return, maybe they're going to save that for banks and tokenize the money markets like they've done at Archax, or, again, tokenized treasuries like Ondo. Maybe you'll be able to hold those in your wallet or with your financial advisor. I think there's going to be a complete paradigm shift for financial advisors and how they rebalance portfolios and on what cadence and the mechanisms in which they use to do that. And we're on the forefront of that at Digital Wealth Partners. So I'll leave you with that. Let me know in the comments below. What do you think? Who are going to be the big players as we see stablecoin regulation move into the space? Is it going to be the Amazon, the Google, the Apple, or is it somebody I didn't even mention here? Let me know in the comments. Like, subscribe, and we'll see you on the next one.